If we're going to make some serious bank together, financial education is paramount. First, understand the system of money, how it's created and how it flows. So what is money? Money is the trusted IOU society uses to trade, measure, and store value. It works because it does three jobs. A medium of exchange. It lets you trade without bartering. A unit of account. The ruler we use to price things. Pounds, dollars, and, imperfectly, a store of value. It carries purchasing power into the future, but inflation matters. You're probably thinking, how does a piece of paper or a number on a screen have value? Because of trust, law, and taxes. We trust banks to honor deposits and enable payments across the network. Law designates legal tender and sets the rules banks must follow. Taxes are due in the national currency, creating steady demand for it. Together, those forces make modern money usable and valuable. Now, where is it created? You hear about the central bank or Federal Reserve a lot, but what are they? What do they do, and how do they differ from your high street commercial bank? What a central bank is versus your bank. A central bank is a public institution that issues the national currency, sets the policy interest rate, the bank rate, to guide financial conditions and control inflation, oversees financial stability, and can lend to solvent banks in stress as lender of last resort. Note, bailouts of failing firms are fiscal decisions, not standard central bank policy, and runs the core payment rails, mainly serving government and banks, not retail customers. Your high street bank takes deposits, makes loans, processes payments, and serves households and businesses. Central banks worth knowing: the Big Four, Bank of England, the Federal Reserve, Bank of Japan, European Central Bank. Basics out of the way, let's talk money creation. When people say banks print money, they usually mean the central bank increasing base money. Base money comes in two forms. A, physical, paper cash and coins you can hold, stocked in ATMs and bank vaults for your withdrawals. B, electronic reserves, numbers on the central bank's ledger. It's digital IOUs that banks use to settle with each other. The central bank creates or drains reserves via asset purchases or sales and lending operations. The interest it pays on reserves helps anchor the interest rate structure you feel in mortgages, loans, and savings. Ever heard the Latin phrase ex nihilo, out of nothing? That's essentially how central banks create reserves, with a keystroke paired with an asset on their balance sheet. Let's touch on quantitative easing, QE, a tool that shapes financial conditions. Under QE, the central bank creates new digital reserves and uses them to buy assets. Most often government bonds, sometimes high-quality corporate bonds, in the secondary market from pension funds, insurers, asset managers, or banks. The seller's bank receives the reserves. If the seller is a non-bank investor, their deposit rises by the sale amount. With fewer bonds available, bond prices tend to rise and yields fall. Investors rebalance, using new deposits to buy other assets, property, credit, equities, which can lift a broader set of prices and lower borrowing costs. It's an asset swap. The central bank's balance sheet grows. Bond on one side, reserves on the other. Financial conditions loosen, and the effect filters into the real economy over time. Quantitative tightening, QT, is the reverse, allowing bonds to mature without reinvestment or selling them back to the market. That shrinks reserves, puts upward pressure on longer-term yields, and can cool asset prices and credit growth. So, to summarize, central banks issue base money and set the conditions. Commercial banks serve people and firms, taking deposits and extending credit. Understand the plumbing and you understand the game. Your journey to financial freedom starts now. Hit that subscribe button and lock in. Educational purposes only, not financial advice.
You like the color of money? Follow Synth Wealth Finance and lock in.